Welcome back. This is the first installation of a new series called What Are the Odds? And where we take a look at various technical and fundamental indicators and we try to assign a probability score so we can, as traders, determine the probable outcome when we see either a technical signal that's generated on the charts or maybe a fundamental event. So I think especially based on the current market activity, the VIX is very appropriate to consider. Now, the VIX is also known as the volatility index, is produced by the Chicago Board of Options Exchange, and it measures the premium on the near-term options on the S&P 500. When stocks go up, traders tend to just buy and hold stocks. When there's a risk that stocks are going to go down, traders may, buy protective puts or sell covered calls to hedge their exposure to the stock market, and accordingly, the premium on the S&P 500 options will increase. So as we can see on the left-hand side of the chart, the blue line represents the S&P 500. In February of 2020, it was trading around 3,200. The VIX is the red line, and it was trading at a level below 20, which is considered to be very low. And when the VIX, historically speaking, is trading a level below 20, it usually indicates the stock market's very strong. Conversely, as the S&P 500 sold off quite dramatically to March of 2020, hitting lows of near 2,200, the VIX ran up to highs of above 70. Now, with that said, what occurred in March of 2020, that sell-off was very dramatic and extremely rare. So I would not, under normal market conditions, even with dramatic sell-offs, I would not expect to see a VIX near 70 or 80. Actually, I would say that 40 is a very big level, between the 40 to 60 level. Though when you see the VIX go up to 40 to 60, that usually coincides with at least a near-term bottom in the stock market. So we're taking a look at data that extends back to January of 2017 through September of 2020. Left-hand data set over here shows us these numbers. Number 5 indicates the VIX at a 5 level, 10, 15, all the way down to the 80 level. And then we took a look from left to right. We see 7-day, 14-day, all the way to 90 days. What these numbers represent is the maximum expected return if you were to buy the S&P 500 when you saw the VIX between a level of 5 to 10. If you were to hold on to the S&P 500 after purchasing it, when you see the VIX at a level of 5, 6, 7, 8, 9, all the way up to, but not including 10, historically speaking, from the January of 2017 through present day, we'd expect to see a 1% return. If you were to hold on to that trade for 14 days, you'd expect, historically speaking, to see a 2% return, all the way up to 90 days, which would have generated a 9% return. So you can see the returns are very modest when the VIX is very low. The VIX very low at 5, 10 level indicates the market is already very strong, and further upside potential is probably not expected. However, notice how the numbers really start to increase, especially when we get to the 35 level. When the VIX is at a level between 35 to 40, and we hold on to this trade, for example, 90 days, historically speaking, that returns a 17% return on investment buying the S&P 500. At a level of 40 to 45, 22%. Now, again, keep in mind these readings near the 60, 65, 70 level, that represents what happened in March of 2020. So it's not very statistically relevant, but please keep that in mind. And also keep in mind that just because the VIX goes up to 40 doesn't mean the stock market's near a bottom. The VIX went up to 40 and then went subsequently up to 70 or above 70 in March of 2020. But when the VIX hits a 40 level, our expected return, historically speaking, really does increase. Taking a look at it from a graphical point of view, the blue histogram bars represent a 7-day return, orange is 14-day, all the way up to the red bars, which represents a 90-day return on investment. And we can see that if we were to buy the S&P 500 when the VIX is between 25 to 30, even 35 to 40, the return's not so great. But when we start to see the VIX between 35 to 40, 40 to 45, that's when the expected returns, especially if you choose to hold on to the trade for 90 days, that's when the expected returns really start to move very much in our favor. The readings above that, 50, 55, 60, all the way up to the 70, 75 level, that mostly in our data set reflects what happened in 2020. Not so statistically relevant. But the takeaway from this is that I would not personally consider buying stocks or thinking that the market's hit a bottom until we see a VIX at least at the 40 level. Second data set over here, we have the same VIX levels at the 5, 10, 15 level. And then across the top, we have these numbers 1 through 12, and that represents the months of the year. So, and there are very specific seasonal factors that do come into play. So in the month of January, if you were to buy the S&P 500 at a level of 5 to 10 in the VIX, expected returns around 5% in the month of January. Notice the VIX was not between 5 and 10 for February, March, and April. The VIX tends to be higher. Notice also that in the month of August, we don't have any readings of 30 or greater. August is a very quiet month. Traders typically employ a buy low, sell high type of approach. So I would not expect to see markets really crash or make very strong moves to the upside in either case. And that's why traders do tend to anticipate the range to continue. But notice what happens when we reach September and especially October. All of a sudden, October, we have readings of the VIX at 40 to 45 and a buy and hold strategy. In the month of October, we tend to see 21% return on investment during those periods of time. So again, it's important not only to understand what the VIX tells us. When it's very low, it usually means the market's already very strong. When the VIX is very high, it usually means the market's maybe looking to reverse soon, but also take into consideration the seasonal factors. For example, the month of August, very, very low volatility. The month of January tends to be a strong month, historically speaking. We have what's called the January effect, when traders will buy back the stock positions that they sold for tax purposes at the end of the year. And then, of course, historically speaking, also October is a very treacherous month, certainly to be said. Now, the final, or actually, let's take a quick look over here at a graphical representation of this. The red axis across the bottom shows us the different months of the year. And then the yellow represents the VIX levels. Notice a huge move to the upside. And that shows us, partially driven, of course, by the March 2020 sell-off, but it shows us a lot of volatility and conversely, a lot of expected returns. When the VIX is at levels of 35, 40, 45, and especially in the months of March, April, and May. Notice the lull that takes place where we see very low VIX readings in the month of August. So that also reflects the seasonal effect. Finally, we can consider the VIX in terms of the total count, meaning that we're going to count here, and we have the same axis across the top, which represents the months of the year, and then the VIX axis itself, 5, 10, 15, which are the readings on the VIX. The number 7 over here in the month of January represents 7 times that the VIX between January of 2017 and January 2017 and present day registered a reading between 5 and 10. However, readings between 10 to 15 in the month of January occurred 47 times. The point being is it's very rare actually to see VIX readings below 10. Usually the very strong markets occur when you see a VIX at 10, 15, all the way up to 20. 20 I think is a real cutoff point. And conversely, we tend to see the occurrences, the frequency of the VIX really drop off as we break above the 30 level. So the vast majority of the trading activity takes place with a VIX between 10 and 30, and especially 10 and 20. But then we start to see very rare occurrences. Take a look, only 2 VIX readings in the month of March with a VIX between 70 and 75. So we should understand the seasonal effects, what VIX levels are good times to consider buying and selling, also coupled with other fundamental and technical evidence as well, but also the proclivity and the expected frequency of the VIX readings. So right now, present day, we're in the end of the month of September, entering October. We have VIX levels around a 30 to 35 level. It's not a very frequent occurrence. Statistically speaking, this tends to be a good place that traders may look to buy. However, caution, keep that in mind. In March of 2020, VIX hit 30, hit 35, and subsequently went above 70. So just because we have VIX above 40, if we do, we're not there yet, but if we do, that doesn't necessarily mean we're at the bottom. It should put us on alert, though, to look for other signs to confirm whether we believe the market has hit a bottom or not. And then, of course, when the market starts trending higher, and we want to use a dollar cost averaging approach, we should be also very cautious when the VIX drops below 20 and starts to get into the 15 and then 10 level. Then we should be leery of adding more positions, because statistically speaking, although markets are strong when the VIX is low, the percentage returns usually aren't that great. We hope this has been helpful. We look forward to seeing you back soon.